Think for a moment. You turn on the news, the stock market is crashing, inflation is breaking records, and everyone is running around in a panic. Under every comment you see on social media, you find the same sentence: put your money in gold and you'll be safe. Maybe you've already done the math in your head. Your bank savings are eroding, stocks are fluctuating, and gold seems to stand like a rock in the middle of all that chaos. Maybe you've already bought some gold, or you're thinking about it, and somewhere in your mind you're thinking, after all, gold always holds its value, doesn't it? The truth is this belief has been embedded in humanity's mind for centuries. But as a finance professional, let me tell you something today. Much of what you think you know about gold is only half the truth, and making investment decisions without knowing that half is like walking through a forest without a map at midnight. Not necessarily dangerous, but you have no idea where you're going. In this video, we'll put the question of whether gold is truly a safe haven on the table, backed by real numbers and real historical data. Let's get started if you're ready. Look, most people understand gold intuitively, a shiny, valuable, rare metal. But the role gold plays in the investment world is far more layered. Historically, gold has appeared in three distinct roles. First, a store of value. Second, a hedge against inflation. Third, a safe haven in times of crisis. Let's put each of those three roles on the table one by one, because assuming gold delivers the same performance in all three roles is a serious mistake. First, let's understand this. Gold was directly pegged to the US dollar until 1971. That means for every dollar printed, the Federal Reserve was required to hold a corresponding amount of gold in its vault. In 1971, Nixon severed that tie. This moment is called the Nixon shock, and from that day forward, gold began to be priced freely based on supply and demand. On that day, the price of gold per ounce was around $35. Today, in 2025, that figure hovers above $2,000. Sounds amazing, doesn't it? But wait, if you don't account for inflation, these numbers will mislead you. We're going to do exactly that in just a moment. Now you might be thinking, okay, but gold hedges against inflation. Everyone says so. And that belief is so widespread that nobody questions it. I'm questioning it, and the data has some very interesting things to say. According to research by Professor Campbell Harvey from Duke University, gold does provide reasonable protection against inflation over the long term, and I stress the long term. We're talking 10, 20, even 30-year perspectives. But in the short term, that is within a 1 to 5 year window, the correlation between gold and inflation is much weaker. It sometimes moves in the completely opposite direction. Let's look at a concrete example. In 1980, gold was trading at approximately $850 per ounce. What happened next? By 1990, gold had fallen roughly 40% in real inflation-adjusted terms. Someone who held gold for an entire decade experienced a serious loss relative to inflation. In other words, someone who put $10,000 into gold in 1980 effectively held an asset worth only $6,000 in real terms by 1990. It seemed to hold its nominal value, but it lost purchasing power. What most people don't realize is this: gold's inflation protection feature is not a myth. It is a real characteristic, but one that depends on very specific conditions. So what are those conditions? Gold provides much stronger protection when inflation spirals out of control in hyperinflationary scenarios. But during normal periods, when inflation floats between 2 and 8%, this protection is significantly weaker. And the inflation the United States is experiencing right now falls into that second category. The Fed's target is 2%, which means gold is being tested in precisely the environment where it performs worst. Now we come to the core question. Does gold truly function as a safe haven in times of crisis? The truth is yes and no, and the balance between those two answers is far more nuanced than you might think. Let's look at the 2008 global financial crisis. Lehman Brothers collapsed in September 2008. The stock market bottomed out. The S&P 500 fell approximately 50% from its peak. What did gold do? In November 2008, the most intense phase of the crisis, gold also fell. It dropped from around $1,000 per ounce to approximately $720. So right in the middle of the crisis, gold also lost about 28% of its value. But then, starting in 2009, gold staged a powerful rally and surpassed $1,900 in 2011. So it failed to protect investors in the short term, but delivered strong performance over the medium term. This is a critically important distinction. If you panicked and sold when the crisis hit, gold did not protect you. If you held on with patience, it paid off over the medium term. What happened in the 2020 COVID crisis? This time, we saw a different picture. While markets were collapsing in March 2020, gold proved far more resilient and quickly recovered, breaking the $2,000 record in August 2020. So what made the difference? Central banks beginning to print money. During the COVID crisis, the Fed carried out the fastest monetary expansion in history. Trillions of dollars were injected into the system, and that created a perfect environment for gold. In other words, gold's safe haven property hinges on one condition. Is there an expectation of monetary expansion? If yes, gold rises. If not, if the crisis is real economy-based and central banks are raising rates, gold can lose value too. Now, you might be thinking, okay, but compared to the alternatives, isn't it still a good option? Great question, and the answer might genuinely surprise you. Look, when making investment decisions, it's not enough to look only at what an asset has done in the past. You also need to factor in opportunity cost. Opportunity cost is the answer to this question. If I hadn't put my money here, what would I have earned in my best alternative? Let's run some concrete numbers. From 1971 to today, roughly 54 years, gold went from $35 per ounce to the $2,000 range. That's roughly a 57-fold increase. Calculated as an annualized compound return, that's approximately 7.5%. Sounds pretty good, but over that same period, the S&P 500 index, with dividends reinvested, delivered an average annual return of roughly 10 to 11%. And that gap compounds into a massive chasm over time. If you remember how compound interest math works, you'll understand why. $10,000 invested in the S&P 500 in 1971 with dividends reinvested and held in a tax-advantaged account would be worth approximately $1,200,000 to $1,500,000 today. That same $10,000 invested in gold in 1971 would be worth approximately $570,000 today. The gap? Roughly $700,000 to $900,000. This is the opportunity cost of that money, invisible but very real. But wait, here comes an important objection. The whole point of holding gold isn't to maximize returns, it's risk management, right? Absolutely a fair objection, and this is where gold's true role comes into focus. Research shows that adding 5 to 10% gold to an equity-heavy portfolio reduces the portfolio's overall volatility. In other words, it reduces risk without dramatically reducing returns. This is the essence of what's called portfolio diversification, and gold genuinely works for this purpose. But holding 100% gold? Mathematically, that means a serious long-term drag on returns. Now, let's go a little deeper. Why do people rush to gold in times of crisis? The answer is partly mathematical and partly entirely psychological. The truth is, gold is one of the most fascinating subjects in behavioral economics because our trust in gold is not largely rational, it's evolutionary. Throughout human history, tangible and physical assets have always felt more reliable than abstract ones. This is a cognitive bias known as the tangibility bias. Try explaining to someone what you actually bought when you purchased a stock. I bought a small piece of a company. Abstract, hard to grasp. But gold?
You can hold it in your hand, see it with your eyes, and it has carried value for centuries. For the brain, this message is clear and powerful. Add to that the psychology of flight to quality. In times of crisis, investors flee complex and risky assets and rush towards those perceived as simple and safe. This is known as a flight to quality, and gold is the most popular destination during these flight periods. Because everyone trusts gold, everyone knows gold holds value. This collective belief creates a self-reinforcing reality. What most people don't realize is this: while part of gold's value rests on real economic fundamentals, a significant portion is built on this collective psychological belief. Is that good or bad? Neither good nor bad, it's simply a fact, and knowing the facts helps you make better decisions.
All right, we've understood what gold is, what it does, and its limitations. Now let's move to the practical question. If you want to invest in gold, what is the smartest way to do it? For the American investor, there are 4 main routes. Each has different advantages and disadvantages. Route 1, physical gold, buying bullion or coins. This is the most direct method. You hold real gold. You can keep it outside the banking system. But there are storage costs, insurance is required, liquidity is lower, and the bid-ask spread, the gap between buying and selling prices, is wider compared to other methods. Route 2, gold ETFs. GLD and IAU are the most popular. Each share of GLD represents approximately 0.1 ounces of gold. IAU trades in slightly smaller units. The advantages of ETFs: liquid, low transaction costs, no storage hassle. The downsides: intangible, management fees apply, and for some investors, it doesn't feel real. Route 3, gold mining stocks, companies like Newmont or Barrick Gold. This option offers higher return potential than gold itself, but also carries greater risk. That's because mining companies are affected by the gold price, but they also bring their own operational risks, management decisions, and cost structures into the picture. It's essentially a leveraged position. Route 4, gold futures and options. This is a far more advanced instrument suited for experienced investors. Leverage is high and losses can be equally high. So which route is right for you? Before deciding, you need to answer these questions for yourself. What is your purpose in holding gold? Short-term crisis protection or long-term portfolio diversification? What does your portfolio currently look like? What is your risk tolerance? What is your tax situation? Because the tax treatment of ETFs and physical gold can differ. Now we arrive at what may be the most important question: how much gold should you hold in your portfolio? Let me be honest, there is no single correct answer to this question, but research does point to some useful directional findings. Ray Dalio's all-weather portfolio strategy includes 7.5% gold. This model aims to deliver consistent performance across different economic cycles. According to JP Morgan research, holding 5 to 15% gold in a portfolio meaningfully improves the risk-return balance. But once that allocation rises above 25%, marginal benefit begins to decline. Most mainstream financial advisors recommend somewhere between 5 and 10%. I agree with this view, especially if you're over 50 and already carry a heavy equity position. Around 10% gold can provide a meaningful cushion. But if you're in your 30s and have a long investment horizon, an equity-heavy portfolio will generate far better returns over the long run. In that case, 5 to 7% is sufficient. What most people don't realize is this: gold is not a strategy in itself, it's a component of a strategy. Putting all your money into gold means taking a different kind of risk, not achieving security. So, a question: what does the picture look like for gold in 2025 and beyond? Look, making price forecasts isn't my job. Nobody can predict gold prices with any consistency, but you can understand the underlying dynamics. First factor: central bank gold purchases. Over the past 3 years, central banks, particularly China, India, and Russia, have bought gold at record levels. That's strong support on the demand side. Second factor, the interest rate environment. Gold is an asset that pays no interest. When interest rates are high, the opportunity cost of holding gold increases. As rates fall, gold becomes more attractive. Historically, gold has performed well during periods when the Fed was cutting rates. Keep that relationship in mind. Third factor, geopolitical uncertainty. The Russia-Ukraine war, Middle East tensions, and the US-China rivalry. These factors suppress risk appetite and keep demand for gold alive. But let me also say this. Gold doesn't always rise regardless of circumstances. When the Fed aggressively raised rates in 2022, gold came under pressure in that high interest rate environment. So you need to look not at any single factor, but at the combined picture all these factors create together. All right, we've covered a lot of ground in this video. Let's summarize, and most importantly, let's talk about what you actually need to do to put any of this into practice. 1. Gold is a real store of value, but it's not perfect. It can struggle to beat inflation, especially in the short and medium term. 2. It does have a safe haven function during crises, but it's not unconditional. When there is no expectation of monetary expansion, this function weakens. 3. The opportunity cost compared to equities over the long run is significant. A near 100% gap over 50 years is not a trivial difference. 4. Letting psychological appeal drive you to put all your portfolio into gold is not security, it's a different kind of risk. 5. Holding 5 to 10% gold in your portfolio is a reasonable and meaningful protection strategy that is well supported by research. Now I'm going to give you an assignment. Stop watching this video and ask yourself, do I have gold in my portfolio today? If not, why not? If yes, how much and in what form? Write down the answers to those questions, because financial decisions only become real and concrete when they're committed to paper. And if you're thinking about optimizing your portfolio with gold today, follow these steps. First, analyze your current portfolio. Then, determine your target gold allocation. Then, answer the question, physical or ETF. And finally, start small. Don't put the entire budget into gold all at once. What most people don't realize is this: financial freedom doesn't come from big decisions, it comes from the accumulation of many small, correct ones. Gold can be one of those small but correct decisions if it's used at the right size and for the right purpose. If you found this video valuable, don't forget to like the channel and subscribe. In the next video, we'll be asking whether bonds are truly a safe haven. See you then!